welcome to this month's Ask the Expert. In our podcast from Momentum, Glyn Owen and James Clemster reflect on a month dominated by political change in two global superpowers and the potential implications for investors. We're also bringing you an additional video this month, taken from our recent Mondial Client Investment Seminar held in Dubai. It features a seminar overview by Mondial Chairman Sean Keller and a look at how investors should be managing risk in today's climate from financial expert Dr. Gordian Gaeta, a non-executive director of Mondial Dubai. For fact sheets on other speakers at the events, Momentum's James Clemster and Emirates NBD Sean Dakin, please speak to your financial consultant. Until next time, on behalf of us all at Mondial Dubai, I'd like to wish you a happy, peaceful New Year.
Glyn, on the face of it, November was a reasonably quiet month for the market, but actually there was quite a fair amount of volatility. What was going on underneath the surface?
Well, yeah, it was actually quite a good month for markets again. Equity markets up pretty much across the board. MSCI World Index, the broad barometer of developed markets, up 1.3%. Emerging markets up about the same in the month. As you rightly say, a degree of volatility. A couple of elections, of course, that no doubt we'll touch upon. We mentioned those in our previous broadcast. But I think really the standout feature was unusually Japan, which had a very strong month and is beginning to catch up on its underperformance earlier in the year against other developed markets. So in the month of November, Japan was up over 5%. By far and away the best performing stock market in the period. So an interesting month actually.
Well, Japan's always a bit of an enigma. What's the news there?
Well, there was an interesting contrast. First of all, they announced that GDP contracted by about 3.5% in the third quarter of the year. That was a little bit worse than people thought. I think people were expecting some contraction in GDP, but the really significant news was the decision to call an early general election. And the government has been really struggling for quite some time. The expectation is that the LDP party, headed by Abe, will actually win the election. And the key thing is that Abe is on record as saying that he would expect the Bank of Japan to engage much more monetary easing. He's talking about unlimited amounts of monetary easing until inflation reaches a level of 3%, as opposed to the Bank of Japan's current target of 1%. And in addition to that, he has said in the past that he would be prepared to have greater political interference in the workings of the Bank of Japan, to have greater political control over the Bank of Japan. So all of those things combined indicated to the market that here was a guy who was very likely to win the election and was intent on really serious monetary stimulus to the Japanese economy. So I think that was the key thing. As well as that, that helps in pushing the yen down by about 3% in the month. So, as we know, the Japanese stock market is quite sensitive to the performance of the Japanese yen, and typically weakness of the yen helps the stock market, which is so export dependent. A combination of those factors, I think, was seen as very positive for Japan. And then finally, towards the end of the month, we saw the government announcing an 880 billion yen further stimulus package, which they think will add about 0.2% of GDP next year. So there are some signs possibly that Japan is finally beginning to sort of take serious action to come out of its sort of decade-long deflationary sort of zero growth, effectively.
You mentioned elections. November was noteworthy for a number of different political changes or
yes,
things staying the same, in fact.
Yes. Yeah.
Why don't we start talking with the US?
Well, the US, as we predicted a month ago, it was won by Obama. The talk now has very quickly moved to the fiscal cliff, and the fiscal cliff is certainly a feature. You mentioned volatility in markets earlier on, and of course the markets have been volatile and almost sort of swinging on a daily basis, depending on what noises are coming out of the negotiations in the US between Obama and the Republicans on how they're going to handle this issue of fiscal cliff. And just as a reminder, What it means is that there are automatic tax increases and spending cuts which come in on January the 2nd next year, unless there's legislation to change that. And those automatic changes would take about $600 billion, or about 4% out of the economy. Now, that's not going to happen, but these negotiations are going right to the line. It's beginning to look as if there's going to be some compromise, and when we hear that, of course, markets rally on the back of it. I'm sure we'll get, over the course of the next couple of weeks between now and the year end, lots of noise on this, but ultimately there will be some resolution. But that's a key factor to look out for in the rest of December. The other big election, of course, was the Chinese election. We knew exactly who was going to win that one. And again, I don't think there's sort of dramatic news immediately out of that, but it looks as if the new administration is going to be more inclined to introduce capital market reforms, a greater liberalisation of the currency and interest rates, which I think will be helpful in the longer term. And there's been some suggestions that there will now, once the election's out of the way, there'll be some fiscal stimulus to get the economy moving along a little bit. And interestingly, as those sort of rumours have been coming out of China, the actual numbers in the economy have begun to pick up a little bit. So it's looking as if the Chinese economy has stabilised or beginning to tick up a little bit after that sort of quite significant weakness in the middle of the year.
Talking of weakness, Eurozone GDP not so impressive?
No, Eurozone GDP in the third quarter contracted by about 0.1%. The numbers coming out of Europe, not just peripheral Europe, but more importantly, Germany and France, suggest a further slowdown in the fourth quarter. And taking the numbers that we've seen so far for this quarter, it's beginning to look as if Eurozone GDP will contract by about 0.5% in the December quarter. And the comments coming from the administration and authorities and the ECB all suggest that it's going to remain pretty difficult in the Eurozone through the first half of the year before beginning to see a pickup in the second half of the year. So, yeah, a tough time, but I don't think any big surprises there. And interestingly, the European stock market, second best performer in the world after Japan in the month, up by nearly 3%.
Okay. Staying with Europe, Greece has dominated headlines a lot recently. It looks like we've made some progress there in terms of the deal.
There has definitely been some progress, and I think that was probably a more important reason for the stock market rallying quite well, performing well in November. The Troika that's been negotiating with Greece, the ECB, the European authorities, the IMF, have agreed now to a rescheduling of maturity on certain debt, to a cut in interest rates, and various other technical measures, as well as an extension of the time period for Greece to meet its 120% debt to GDP target. And that follows the Greek government signing through further tax increases, an increase in the retirement age, and spending cuts. So there's now been agreement on all of those. Probably rather sooner perhaps than the market thought. That was certainly seen as a positive factor and has definitely bought more time for Greece and the periphery generally. So yeah, I think that was quite a sort of a positive factor for the European markets.
Okay, and overall, you've referred to equity markets already. Any other notable performances last month?
Well, we saw bond markets, government bond markets performing reasonably well. Not as well as equities, but actually treasuries returned about just over 0.5% in the month. Credit had another good month. High yield up by nearly 1% in the US. So it was generally a positive period for sort of risk assets. But I wouldn't say any sort of standout features among those. Commodities generally fairly flattish. Gold did very little in the month. So it was really a month that I think was dominated by the equity markets.
Great. Thanks, Glenn.
Okay, firstly, let me start by thanking you for your time and attendance today and welcome you to the Mondial Annual Investment Seminar. I'd like to start by thanking our sponsors, French Provident and Royal Scandia. Thank you very much. Without their money, we would have to pay for everything ourselves, so thank you very much. Now the main purpose of this occasion for us is to start to build an environment in which we manage your performance expectations. Why? Because we want to build stronger client relationships. And yes, that sounds altruistic, but we are being driven by a much stronger commercial force. and that is seismic changes in the way financial advisors will be paid in the future. So the future of a financial advisor is no longer going to be next year, our best advisor will not be the best salesman. It's increasingly moving towards the guy with the most assets under management. He will be the one with the best smiley faces. The good news for you as clients is that your money will be treated better because you can move your money from anywhere, from any brand to any advisor. You want to be with the advisor that is managing your expectations well. So that's the reason why we created this title. The new normal is down to markets, but the bit about your portfolio is down to how we manage your portfolios moving forward. So there has been pressure on the industry for some time. Post-Lehman's, we know that the bankers have been getting a kicking. Fund managers also, very few of them, about 1 in 5 beat benchmarks and indices. In our business, there's a major assault on front-end commissions, starting in the UK with RDR, Retail Distribution Review. In Australia, they call it the future of financial advice. And even last week, the DFSA joined the kicking on what they call the gracious commissions up front, and I don't know what it means, but I know it's not good for upfront commission sales. So it means that there are massive challenges for the financial consultancy business, and I thought I'd share some of them with you today by talking about my love life. Why not? Now, the first celluloid love of my life was a lady called Miss Brahms. Miss Brahms, aka Wendy Richards. She basically worked in a 1970s sitcom called Are You Being Served? Now the thing about the 1970s was if you were retiring today, you should have started your pension planning around about the 1970s. Now Wendy then became Mrs. Fowler in EastEnders for 20 years up till 1990, and by that time there were some massive changes. Now here's the point, if we're supposed to be managing your money, then one of the biggest problems we've got is the changing complexities going on in the markets. So these are the things that affected the EastEnders cast that weren't affecting Miss Brahms. They include, for the first time, there's more people now living in towns than there is in the country. That makes the consumer a massive mover of markets. Political risk, you could have said in the 1970s that the oil crisis caused a tumble, but since then, every single political risk is increasing market volatility. What about Sandy? As the Bloomberg heading said, it's climate change stupid. That wasn't going on in the 70s. Then we've got the energy dilemma. Whether Mr. Slim Pickings finds anything other than oil and gas in his shell, it will affect commodity prices in the near future. Then we've got what I call the lasagna factor, because I remember in the 1970s my dad threw a wobbly at my sister because she came and made him a lasagna with salad. Now he was a meat and 2 veg guy, but it's had a massive impact, as you'll see in a minute, in particularly in respect of the pension time bomb. So the pension time bomb, what is it? The reason I bring Miss Brahms is because she had a 40-odd year span in the trade, and that's typical of a working life. So your typical pension starts, you go to university, you start working around about 21, then you work for another 44 years, allegedly funding a pension, and then we're told by the World Health Organization that we'll drop our clocks around about 80 to 90. Now here's the lasagna and salad factor, because 5-10 years ago that age was 75, and it's creeping on virtually on an every assessment basis. In fact, last month the insurance industry in the UK started working on pension plans for people living to 110 and 120. So this problem of saving for 44 years and then keeping you alive for another bunch of period of time is very, very difficult. Let's put it this way. If we were taking 10,000 dirhams a month out of the pension today, you should have been funding 3,333 into your cash pot for that 44 years. Now, of course, it's not as simple as that. It's very, very complex. And the main complexities are to do with the growth factor, the volatility factor, and, of course, inflation and the erosion of your money. How difficult is this? Well, here's one point I would like to get across when we're talking about the difficulties of being a financial consultant. It's not particularly easy at all. Here are 2 main papers on the subject, both by guys that have contributed to Nobel Prizes. And you can see from these titles that they're basically saying no one really knows how to plan pensions, to build up enough money and to fund it. The solution is in regular discussion, so that you're continually working on the probability that you're going to be all right. To sit down in 1970 and say, you know how you're going to be in 2010 when you retire, or 2012, whatever it is now, is absolutely silly. It has to be a regularly managed issue moving forward. Now, if we do get it right, there's a lot of nice things coming to financial advisors. And this is from an Australian. He's a futurist, and he basically said, therefore, that the world moves with big themes and big leaders. The first one was when man learned to speak, and the tribal elder was the main leader. Then, in 1485, that guy stuck the thesis on the church door in Wittenberg, and the religious leader became the main influence. Then in 1957, two things happened. I was born, and the microchip was invented. Out of the digital era came the politician. And this is what he thinks: as soon as we work out how to manage pensions properly, then the trusted financial advisor will be more important than the politician and the religious leader. Yes, you believe what you will. The problem is, of course, is we're dealing with a number of myths in our business. In this market, there are many people, when we talk to our clients, and they're upset about +4, -4, etc., that it's amazing how many people tell us that their friend has made 20% per annum. This is equivalent as finding the mermaid. And I guarantee that if you find a guy that can do that, then I'll share a couple of 100,000, because that's the headhunting we can get for someone who can do this. The problem with this market is a right Pinocchio market, because even the big banks here tell our clients that they're regularly hitting 30%, 40%. It is, of course, a myth. The other problems we've got is in managing expectations and dealing with what I call factions. Let me give you two, for example. One is utility theory. Now, Daniel Kahneman won a Nobel Prize for something like this in 2002, and basically said, if I gave this lady at the front 1,000 dirhams, she would be quite happy. But if I gave her 100,000 dirhams, then for every 1,000 dirhams she wouldn't be as happy. She might even give 1,000 to her husband, which wasn't the point. However, if she loses 1,000 dirhams and then loses another 1,000, then she gets increasingly angry with us. So it's an issue for us because of the amount of people that say, I need to make 15% per annum without looking at the risk, because they are going to be coming back if the numbers miss. The other thing is the simple issue of market efficiency, and I put it up there because it is very important when looking at pensions and the pension time bomb that you stay with the faith. By market efficiency, I'm looking at here the fact that markets go up and the markets go down. This is the dot-com and the credit crisis, and you can see that basically markets tend to refer to their means. James corrected me with my graph because that's a performance mean, but it does come back to a value mean. Therefore, when you're planning for the medium to long term, taking that medium term view is absolutely critical. And the biggest hits on pensions and long-term investments are people coming away from this diagram. So, Miss Piggy, the reality. This session today deals with something that's quite peculiar. It's happened since 2008, but we're clearly moving into a different type of market, what we call the new normal. Now, the old normal, what hasn't changed for us is that we see our job as trying to beat inflation. So this is the rising price of goods and services, this is the rising price of a can of Heineken, the rising price of Johnson & Johnson's talcum powder, whatever it is you're spending your money on. Everything above that line is improving your purchasing power, everything below it isn't. Now, in the olden days, the old normal, we would hope that the risk-free rate, the returns on government bonds generally held to be the US bond and sterling bond, because they've never given up, they've never not paid their debts, that those returns would be somewhere above inflation. And this is the problem, that the new normal doesn't have that in its lexicon. Here we've got the top end of the risk-free rate would be Greek debt. And there's not many people saying that that's risk-free. And at the bottom end, you've got countries like Switzerland that are promising not to give you your money back. So we've got negative capital returns. That classically is not normal. Therefore, we have to be very conscious that to get the risk premium, we have to be a lot more careful and be totally aware that those plus 20% and plus 30% are just not going to happen. So one of the reasons we wanted to restart these seminars was to start making sure we're getting this message across that the place to be is 3 or 4% over the inflation and risk-free rates. The important thing is to improve purchasing power. The important thing is not to try and hit those big numbers. Right. So, are you being served? Now, the main aim for us today, just to finish off, is to also bring to you the fact that we're planning our business around our website. So, as we move forward during the course of today, hopefully you'll get an inkling that our core and satellite investment philosophy is very important to us. The core is generally the bulk of the money, the 50-60%. If that goes well, then if 50-60% of your money is moving in the right direction, then we can take a little bit of risk with everything else. So I'd like to point to a couple of points in our website. Number one is what the Managing Risk button. In there you will see all of the core and satellite investment philosophy. You will also see the two fund managers that we're talking to today, and their fund sheets and their view of the world in that section. Everything that isn't core is satellite, things like student accommodation funds, cooks, anything that isn't a multi-asset manager we put in here. The other thing I'd like to bring your attention to is for the last 6 months we've been putting videos in this section. And yes, Glyn Owens, who generally is the guy being interviewed, doesn't look like Butch Cassidy or Tom Cruise. He's not a sex symbol, but the content is fantastic. And he's normally out there with quality content before you start reading it in the newspapers. So in terms of insight, in terms of knowing what's going on, I'm basically saying to you, if you keep up to date with these tapes on a monthly basis, you'll actually pretty much know what's going on. So, in future, those that use this know that we were the first in this country to bring online aggregation. Hopefully by January we're going to make another new launch. This is where we see the future. It's not only just providing with evaluations, but more intricate analysis. So moving forward then, the first guy we're asked to join on stage is a non-exec director. Pauline is a professor of law, maths, business studies, just about anything you can think of. He's also a private equity investor and an expert in risk management. The real reason why we selected him was because he looks a lot like Einstein.
Ladies and gentlemen, turn on the microphone. Okay, can you hear me? I'm smiling. I think, thank you very much, Sean. Sean's always very worried when he invites me because he never knows what I'm going to say. So I should keep to good form and I should say things which are not necessarily the house view. Yes, I'm working on the Einstein persona. First of all, good evening to the investors. As you can see, the traditional investor first looks at the strategy, then research, but nowadays just one leap to animal spirits towards the goal of dollars. But it's not only the investors. Here is Hello Typical Fund Manager. They all ran on position number one either the last 6 months, 3 months, 12 months in one special area. So that is the community we're dealing with. So, now that we are properly introduced, all of us, and also, of course, the IFA is also somewhere with the small guys in the background that actually manage your money. I need to talk about risk, and I need to postulate 2 key points that are sort of religious in my world and in the real world. The first one is that in a natural system, nature, our size, our intelligence, our shoes, whatever, we are normally distributed. That means that there's about as many bad ones as good ones or big ones as small ones. it's actually symmetrical. Because of that, most of us have the same amount of good news and bad news, and it just seems sometimes there's more bad news, but then we take good news for granted. On average, it's the same. Every man-made system on average is non-normally distributed, i.e. it is not equal bad news and good news. In fact, there are more bad news. There are catastrophic good news. Sandy was one. There is no equivalent good news to Sandy. It doesn't exist. That is critical in thinking about risk. It is not equal. Now, let's talk a little bit about the concept of risk, and I will then give you a few messages. First, most people equate risk with uncertainty. It's not the same. Now, we have a Mondial Academy, as you know. We teach risk courses, and according to the Chartered Institute of Securities and Investment, the difference between risk and uncertainty is that risk is measurable and uncertainty is not measurable. We teach that because we have to. Of course, it is not true, but that's how it is. It's in the script, so we have to teach it. The reality is very different. The reality is risk is the negative variance from your expectation, whereby your expectation is based on the best professional judgment. In other words, based on a Mondial advisor. That is the best professional advice. Uncertainty comes in two forms. One is because you are not a client of Mondial, for example, so you don't have good advice. Or because something is out there that you've never heard of. Now, the tsunami in Thailand, the tsunami per se was well accepted as a potential risk. What actually happened was beyond anything we could imagine. That's uncertainty. But you can measure it very well. We know how many people were dead. We know how many houses were destroyed. And we know the wind speed. So this is really important before I talk about a few points. 3 messages on risk. Risk is not equal regret or reward. It is another fallacy that when you make a bad choice, you took more risk. When you make a good choice, you feel better. And it's actually a utility curve that Sean showed you. 2 is investment is not speculation. And as Sean said, 30% investment is a myth. 30% speculative wins is not a myth. In fact, you can double your money in one day. It's not investing. Third one is the monkey outperforms all. And I will tell you then what the monkey actually is, because it is actually quite interesting. Then we have some practical applications. You cannot eat well and sleep well. So you have to make up your mind in the investment business. 2 is alternative assets are mainstream. And 3, portfolio insurance is paramount. I will talk a little bit about that. Watch my time. Very strict with me. Now, this is a survey of 5,000 investors like you, for those who are investors, who actually said in summary, facing low rates, high correlations among asset classes, i.e. everybody is good or bad, and fear of loss due to market volatility, investors the world over are worried about generating enough income for retirement, which is exactly the point that Sean made. What investors want is a new approach that puts risk first and helps them build portfolios that can better withstand volatile market movements so they can stay invested and meet their savings goal. And if you can read that, so I'm reading it for you. Now, regret comes when you are like that. I will read the caption says, all my merchandise of the highest quality and comes with a money-back guarantee. Genuine Rolex, genuine Gucci, or option tips, 100% return in 1 week. That is what you see. It makes you salivate. That is not taking the risk concept into account. Now, here, this sums it up again, I like these cartoons. The caption says, the chance of rain tomorrow is 90%. Again, this is not a forecast, but a sign of elevated risk. If it does not rain tomorrow, don't tell me I was wrong. And here is selling umbrellas for sale. And that is exactly the point that we face when we look, most of us look at risk. Because risk is the negative variance. I'll give you quickly 2 examples. When you go to the casino and you bet money, you take a risk. Most people agree. Most people, you ask them what risk, most people say, the risk is that I lose money. Wrong. The losing of money is a certainty. The moment you put the money on the table, it's lost. You're buying an option, but the money's lost. The risk is that when you go to the toilet, you break your leg because the floor is slippery. That's a risk. And that is something that is really fundamental to understanding that. The certainty in an investment, when you give money into something, and you buy an asset, or a share of an asset in an equity, or an obligation, a bond, a share of a liability of a company, then that's a certainty that your money is gone. The return, that's a different matter. Now, investment is not speculation. A conventional valuation of stocks, which is established by the mass psychology of a large number of ignorant individuals, is liable to change violently as a result of a sudden fluctuation of opinion due to factors that do not really matter to the prospective yield. John Maynard Keynes, 1936. Absolutely right. I just put the ignorance in bracket because in the meeting I have fundamentals here, so be polite. So, that's what he said. In 2012, John Bogle, who actually invented passive management, he said, forecasting the prospective yield of an asset over its life, that's an investment and creates value, rather than forecasting the psychology of the market, which is speculation in price. Most of us look at our portfolio, or many of us look at our portfolio and get worked up about the price. Very few of us get worked about the value. We should get worked about the value, worked up, not about the price. Now, this is what typically happens. The guy goes to his IFA and says, I'll take 585 to 1,000 FIICs on the margin. Hold the analyst's opinions. That is exactly what happens. Animal instinct. Now, this is the Martial monkey. In his best-selling book, The Random Walk Down Wall Street, Professor Martial claimed that a blindfolded monkey throwing darts at a newspaper's financial page could select a portfolio that would just as well as one carefully selected by experts. Apologies. Who believe the experts that they would on average produce results which are no better than the cap-weighted benchmark. The latest academic study, very interesting study, said, as it turns out, Dr. Martial's assessment was too modest. In empirical testing, the monkey reliably outperforms at least before transactional. The point here is that the monkey doesn't do worse. They also don't understand risk. Now, there is, if somebody's interested, I quoted the study. There's a good reason why the monkey outperforms reliably, and that is because the weight of the companies. So, think, for example, Financial Times, London Stock Exchange. If you simply throw darts, on average, you will hit a number of small companies, but not all big companies. You will, on average, hit some tech companies. You will, on average, hit exactly a balanced portfolio that, on average, because you are not conditioned by preferences or dislikes, will actually outperform the market. In conclusion, there is no change, more or less, to risk in the new normal. It's just the same. Risk is an inherent feature and you live with it. You have it for breakfast, lunch, and dinner. Just live with it. It's not uncertainty, it's simply knowing that it will be wrong. What has changed is the volatility and the politics, but we'll leave that for another time. Or the thermometer of risk. When you measure risk, something has changed. It's temporal, it's instantaneous. It doesn't tell you the future or the past, it simply tells you what it is. And for investors, as opposed to speculators, this does not matter. However, you now have more choices in terms of asset classes and better risk mitigation strategies than ever before. And if we learn from our mistakes, and that's by no means certain, then we are better equipped than ever before with a good investment advisor. I have to add to that. Chasing high returns involves high risks, as Sean said. I hate to agree with Sean on this, but it involves very high risks. Very high, unexpected results. Actively managing or reallocating your portfolio also may achieve high returns. It brings very high transaction costs and very high fees. Holding asset allocation fixed, on the other hand, against a fundamentally changing environment is not intelligent. It simply is not intelligent over 25 years to hold everything constant, unless you hold Warren Buffett's Berkshire Hathaway shares. That was about the only share in the world that over a 20-30 year period, I can't remember the 70s because I'm too young for that, but that actually managed to outperform anything. And there are some very interesting studies on why it is, and it is not because he took more risk, it is because in technical terms he took less risk, but that's also only half of the story. The real story is that he's in the insurance business and not in the investment business. And that makes a huge difference, because the insurance business gave him what I'm exactly saying: your portfolio needs insurance, otherwise you won't meet your retirement goals. Alternative assets are in. I hate to say that, and also to some of the fund managers, but they are in. They have become mainstream. That means liquid, they are predictable, and they are well managed. Generally, hedge funds are out. Some of them are still very good, but generally hedge funds were not hedge funds. 90% of all hedge funds were directional traders, were speculators. So we don't like speculators. 10% of them have done very well and still are doing very well. So this was in the 70s. You had the motorway, mutual funds on one side, individual investors on the other side, and the hedge fund express running through the middle. This does not apply anymore. And this is one before last slide. In the new normal, there are two principles that I would like to communicate to you. Past investments and future investments are not the same. If you are sitting on an investment that has not performed, there is a different decision-making model than actually putting new money into investments. The second one, standard asset classes, and I have to apologize to some of the multi-fund managers who may not disagree with that, will underperform alternative assets. There's no doubt about that. Maybe not by much, but they will underperform. Alternative assets include collectibles, property and REITs, real estate investment trusts, foreign exchange, commodities, private equity. I read today that KKR, one of the leading private equity funds, is now putting up private equity funds for individuals with $2,500 minimum investment. Because, one, they need funds, but two, because it's become a mainstream tradable asset. Don't need $10 million for that. And structured finance, derivatives, in particular futures, and some hedge funds. Now there's a big asset allocation debate, and I think the house view, Sean was very kind when he says, core being 50-60%, because he knows that I'm pushing on the other side. In fact, the house view is sort of 20% alternative assets. But I think it is closer to what Sean said, 40%. It is, to some extent, critical, and it includes your portfolio insurance. Mandatory diversification insurance includes high dividend stocks, convertibles, precious metals, derivatives, and capital guaranteed products. I only mentioned two. One is convertibles and warrants. When you have a stock you like that gives you a standard return which exceeds inflation, and you have a zero cost option for the share price increase, you can hold that for 10 years. Gold, it has been calculated that 2, 3, 4% of gold, or gold stocks, or ETFs, or gold miners, actually reduce the risk profile of your portfolio, i.e., in bad times slows it down, and in good times does no harm to you. There are certain mandatory alternatives that are good and important to an asset. And I think the fund managers will not disagree with that. And I'd be interested to hear what the fund managers have to say. My last slide is, which I like most. You have the little guy here looking into a microscope, and it says, kids take turns, and you may all look at my latest estimate on prospective equity returns. And that is sort of my prediction of the equity. Since bonds are returning close to zero above inflation, and cash is not a long-term holding pattern, you have to look at other things. And if you understand other things, advisors understand other things, then you actually get a better portfolio performance. Because for me, when I look at 25 years from 1999, whatever it was, and the money has done not very much, then that is pretty depressing. But it is not the risk. That was a predictable, accepted outcome. So we really need to push ourselves to think about what we should be doing. In my view, we need to mix our portfolio. Anyway, I hope it didn't bore you.